Hello Sector Watchers, welcome to the show. This is the 67th episode of Sector Spotlight for Tuesday the 16th of February, and I'm recording it on Monday the 15th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. I hope you all had a very good, relaxed President's Day, because it was a market holiday, bank holiday, so no markets were open. And this show I would like to obviously go over the rotations of last week's asset class and sector rotation, and then I want to spend a little bit more time on the subject of an article that I wrote in last week's Chart Watchers newsletter on the sector rotation model. I've done that before in the past, but I think that right now, because of the outcome, I'd like to share it a little bit more in depth with you. So we'll go over that. And then see if there is a little bit more time for another subject. But before we go to the show, obviously if you've got anything to say or want to share with me, please use any of the handles on the screen or simply drop me an email. You know I love the interaction. And last week's video was a good example of that. I think we had like 20 comments, and I just love to see that people are actually engaging with the content that we're providing. And in that light, I got a lot of nice comments and feedback on the short clip that I shared with you of the people in the streets of Amsterdam last week. And I think I found another one. I found another clip that relates to the weather that we had last week, which was very icy and cold and frozen. But it also means that there was a lot of skating going on the canals and on the little lakes. And I hope that the clip that I found for you this week at least brings a little bit of a smile to you when you're watching it. So after a pirouette turning female police officer, we're gonna see if the markets are running around in circles or doing some pirouettes for us. As usual, we have on the left hand side the asset classes on a daily RRG, and if I sort this on percent change, then we can see that our benchmark, the Vanguard Balanced Index Fund, ended the week up 90 basis points, and the table was led once again by commodities. GSG up 3%, DJP up 2%, despite the fact that the rally seems to have stalled, or at least for the last 2 days. The tails rolled over or moved sideways. V&Q, real estate, was another good week, 1.7%, but that also started to come down at the end of the week. It picked up a little bit of relative strength, but the direction is lower. And then we have ITOT now rotating nicely back into the leading quadrant, and that's offsetting all the red tails that you see inside the lagging quadrant. So we've been talking all along for a preference of stocks over bonds, and that's now back into play on the daily scale as well. So that's it for the short-term rotations that we saw last week in asset classes. If we move over to the right-hand side, where we have the US sector universe, and we do the same trick, we rank it based on performance, then we see that SPY actually rallied 1.3%. So SPY up 1.3, where the US stock market is up 1.6. That's another relationship where you can immediately extract some information, because the total stock market index is, as you would expect, the entire market. That is 1,500 stocks. So that goes from large cap all the way down to small cap. And if we look at SPY, that's up 1.3%. So that's 30 bips lower than the total stock market. Immediately from this, you can draw a conclusion that the lower end, so mid and small caps, actually performed better than large caps, because SPY is, as we know, only large cap stocks. Nevertheless, 1.3% up, that's a very nice week for stocks. And if we dive into the individual sectors, then we can see that it was another good week for the energy sector, which is probably the longest tail on the chart, moving straight through the middle, right back into the leading quadrant. So it went through some sort of a setback and is now back into leading. So that's backing up the positive view for energy. Another good week for technology. We had a little bit of a drop at the start of the week, but towards the end started to move to the right. And we all know, we talked about it last week, that technology is one of the sectors that is doing very well on the longer term time frame, and in my view, one of the sectors that will lead the next leg up once we get it. And the same goes for communication services, which had a good week, up 2.2%. And if we look at the tail, then we see that during the start of the week, we continued to lose a little bit of momentum, but at the end of the week, we started to move sideways and pick up relative strength. So that's good. That's also backing up the longer term view. And if we go to the long-term stuff, then we see that our discretionary sector, which we talked about as one of the three sectors to lead, was down 1.1, and that's actually moving towards the lagging quadrant. Not as good as we'd like to see it, but in the light of the longer term rotation, I'm going to continue to view this as a temporary setback, but we'll need to keep an eye on it. Let's finish the list. We have financials up inside the improving quadrant, going back to, so it had a very good run, rolled over, and it's now back into improving and moving towards the leading quadrant. So improving there, at least at short notice as well for financials. Industrials, a little bit further to the left, and the big difference here is the decrease of distance between the dots on the tail. So you can see that if you look at financials, then we got, the last one was a little bit shorter, but here we see that's also the longer tail that you see. And if you look at industrials, that's shorter, and then especially over the last 2 weeks, you see those observations getting closer together, and that implies that there is a bigger risk, or the odds are bigger for industrials to roll over and move back down towards the lagging quadrant again. Healthcare not exactly doing as I initially thought, but I think we've got to say farewell to that scenario. Back into the lagging quadrant, at least on the daily RRG, and heading deeper into it, so that's not really good. Real estate losing relative strength there, so now both on the asset class level you see it coming down, and on the sector level you also see it coming down, and here it's actually starting to move to the left, so it's starting to lose relative strength. Materials, inside lagging, moving higher, picking up, but this is the weakest sector inside on this chart, so on the daily scale. So this is going to be taken with a grain of salt because it's only picking up momentum and not relative strength. That usually isn't too good of a sign. And then we have staples, which actually rotating back down, so it peaked into the improving quadrant and is now crossing back down into lagging, so going as we expected to be an underperformer. We already looked at discretionary, and then here we have utilities, which is pretty much the opposite of what you see in energy. That would actually be a pretty nice pair trade, long energy, short utilities, because you see that they're moving opposite, and they've crossed each other at the almost in the center. Look at this. So here you see it. This is like energy shooting off into the top right, utilities shooting off into the bottom left, and that move is now underway with increasing length on the tail for utilities and increasing length for the tail on the tail of energy. So that wraps up the rotations for this week in both asset classes and sectors. Following this look back, I usually move on to putting those rotations on a weekly scale to give them a little bit longer term perspective. And we're going to do the same now, but what I want to do is actually bring that into context with the article that I mentioned in my introduction. And the article talks about the sector rotation model. And when I talk about the sector rotation model, it's the sector rotation model that is based on Sam Stovall's S&P Guide to Sector Rotation. And we actually have that model on the StockCharts.com website. I will put the link in the comments below, so you'll have a straight path into that page, because it is actually positioned underneath the perf chart where you can look at sectors and performance over time. But the model is actually slightly hidden just below that, and we have a link that puts you right onto this screen. And what you'll see here is two curves. One shows you the economic phases of the market, that's the blue line, going from a full recession into an early recovery, and then when it moves above the average, above 100, we're in full recovery, and then we peak, and then we go to an early recession, and then we go into a full recession, etc. That's how the economy flows through time. Now, it's no secret that the stock market usually leads the economic cycle by, there is a difference of variations, but by a number of months. I think like 6 to 9, maybe even 12 months lead time is what's usually used in economic models and classes, etc. And that's the orange line that you see. So you see the market bottom, and the economy is still in a full recession, but the market is anticipating a recovery. And then when you go into an early recovery, that's when your bull market starts. You got your market top when the recovery sort of completes, and then the market starts to go into a market top and then into a bear market, and then you got the same sine of waves that leads the economic cycle. And you see on the top of that model, you see the various sectors, and these sectors are expected, at least theoretically, to outperform the market during that phase of the cycle. So in a full recession, we have technology, and that's when the market is bottoming out, right? So in that full recession market bottoming out, you see technology, discretionary, communication services, industrials. And then when the market starts to peak and the recovery comes to fruition, you will see materials, staples, energy, healthcare to outperform the market. And then when the market goes into a recession, early recession followed by a full recession, you will see utilities, real estate, financials to actually lead the market. That's not necessarily saying that they will have absolute gains. They will beat the market. It's relative strength. So financials may go down in price, but they will beat the S&P 500, similar for utilities or real estate. That's the theoretical model. And what we're trying to do here is to actually put all these pieces of the puzzle together and make it into a coherent view for the markets that can serve as our, call it a roadmap or so. So what I want to try to do now, before the break, is actually go over the individual sectors and see if we can label them and put a color code on the bar on top. And if we start with materials, then I think that what you see here is, and we discussed that prior, is a neutral view. So you see that the relative strength, their period of outperformance has rolled over, and it's not super negative yet, but it's not super positive either. So I'm going to set a neutral view for the materials sector. Now for communication services, that's clearly a positive. We wrote about that last week, that those views don't change overnight, and as a matter of fact, for communication services, the view even got stronger because we had a very strong week last week, as you can see on the bar here, and we're now convincingly breaking out of that sideways range in communication services. If we go to energy, then you see that is working its way better. It's way on the right-hand side of the RRG, as you saw it. Let me bring that RRG here in place. You see that it's on the weekly scale, it's the strongest sector. It's losing a little bit of momentum, but it's the strongest sector, so it definitely deserves a positive view, so an overweight or a plus view for this purpose. And as a matter of fact, I'm actually watching for energy to break above that horizontal resistance area to really start going and really turn that relative strength around into a more steep rising. Now, financials is continuing to push against that overhead resistance level around 31 and a half, and it looks as if it's on the verge of doing that. And you'll see that the relative strength line is actually pushing against an overhead resistance level, and you see that the rollover here is this little hiccup that we have. But in terms of RS ratio, financials are the second strongest, so they also deserve, you know, a green shade, a positive view actually. Now if we then move to the next sector here, and that's industrials, then I think that and you see that it is on the RRG, it's right here. It's still on the right hand side, but rapidly losing momentum, so I'm going to label that as a neutral, not in lagging yet. It could still turn around, but I doubt it. And what I see here is that this overhead resistance is getting stronger and stronger, and you see a continuing loss of relative strength. So industrial is going to be a neutral view for this purpose. And then we'll have technology, again, one of the three musketeers, one of the three leading sectors, very strong. So we're going to put that or keep that at an overweight, at a plus, and it looks as if we're ready to break out of that range and push both RRG lines back above 100, which would only support a further improvement of technology, which we actually have on the screen right here, rotating back into leading very nicely. And then we have staples. That's one of our weaker sectors. It's inside the lagging quadrant, and you can see why. So there is no doubt that staples is one of the underperforming and the weaker sectors. No sign in place that that's going to turn around anytime soon. So we've got a red, we've got a minus for consumer staples. And then we have real estate, which is actually, you know, it's starting to improve on the price chart, but the relative strength is still so far to the left that in terms of relative strength versus SPY, real estate is an underperformer. No matter what the price chart is doing, for the time being, we just got to judge this as a downtrend, as a declining trend, and that's what the RRG lines are picking up. And you see the RS momentum hicking up a little bit towards 100, but it's not strong enough to completely turn around this red RS ratio, as you can see here. Also, the very short tail tells you that there is not much power behind that turnaround yet. So real estate, red, negative, underperformer. And now we've got utilities, which is also pretty clearly an underperformer. It's inside the lagging quadrant, and you see that relative strength recently broke below its previous low, and you see the hiccup here in the RS momentum line. That's because of the sideways move here, but the raw relative strength line already seems to be starting to break further down again. So we're gonna keep utilities at an underperform. And then finally we have healthcare. Oh, one before, we got one more. So we got healthcare here breaking lower. So healthcare is, I got it at a neutral because of the break up here and the sort of rising RS ratio, but I doubt it. It's definitely not a strong buy. It's definitely not one of the sectors that you would expect to outperform for the time being. So neutral at best, I'm afraid, for the healthcare sector. And then the last one is consumer discretionary, and let's bring that up here. And you can see why we have that as a positive, because it is actually still curling back up, and it needs to start picking up relative strength, i.e. move to the right once it moves into the leading quadrant. We still have a nice series of higher highs and higher lows. We just do need to break out of that range, and we certainly expect the relative momentum or expect relative momentum to actually push higher, bring it into the leading quadrant, and join technology and communication services again. Stay tuned, we're going for a 30-second break right now, and after that I'm going to bring all the stuff that we just talked about with regard to the sectors and all the other elements of the sector rotation model into one picture and draw a conclusion for the market as a whole. And welcome back. On the screen you see the top side of the sector rotation model with the sectors and the labels as we just discussed them. And the reason why I've actually stitched two of these images together is to show you what I tried to describe in my article, that this is an ongoing pattern of the same wave. So they are positioned behind each other. So if we start here, then immediately after you get this, so you got this ongoing thing. And if you look where the sectors are positioned, you can see that there's a big cluster of green right here with financials, discretionary, technology, communication services, and maybe even industrials. When it turns around, you noticed my indecision, my doubt when I talked about industrials, and maybe even goes for materials. So you see this cluster of green, this cluster of outperformance located or positioned on the scale below, somewhere, I think, between full recession and early recovery. And if that's true, that means that the market is moving from a market bottom into a bull market. Now, that may sound strange when you think that the bull market has started in 2009, but sometimes you've got these stealth rotations, this little thing that all of a sudden comes out as a recession or a bottom in the market. Well, we haven't even noticed it, or not really materially noticed it. So I'm keeping that in the back of my mind. But from a sector perspective, looking at the labels that we just attached to those rotations as we currently see them on the RRG, we got to say that the economy is somewhere between a full recession and an early recovery. Now let's move to the sector rotation model, because there are more pieces to the puzzle. And here you see the image that we just had stretched out. But you can see that there is more to it than just the sectors. And here are a few metrics that we can double check to see if they actually support the current positioning of the sectors in the economic cycles. Now, the first one is consumer expectations, and the ticker symbol that I'm using for that on the StockCharts website is $UMCSENT. That's the University of Michigan Consumer Sentiment Index. Now, these are economic indicators. They're notoriously lagging. That's just the way it is with economic indicators. And if you look at the chart here, it doesn't really look that good. Going back to the model, we have to decide whether this is reviving, rising, declining, or falling sharply. Now, falling sharply, I think we already had that. I don't think we're falling sharply. We could be declining, because this could be a little hiccup in a longer decline, just as we saw it here and here. So not sure. Reviving, definitely a possibility, because we fell and we're now reviving? I don't know. Or are we already rising? Did we already go through the reviving, and are we now rising? Are we on the way up? So I have a question mark there. I'm not sure, I'm not entirely sure how I should read this indicator. If we move on to the second metric, that's the industrial productions. And the ticker symbol that we're using here is $IPI, the Industrial Production Index. I think that's a rising line. We had this sharp fall, and now we're rising. And that bottoming out phase was very short-lived. You can see that, you know, the bottoming out usually takes a little bit longer time, but here we had this very sharp drop and very sharp rise. So I'm pretty confident that this is rising. If we go to the third metric, that is interest rates. Now, interest rates is a wide subject. You know, you can go from 3 months to 30 years. So I've sort of picked middle of the road number, the 5-year treasury. And you can see that that is actually bottoming out. So interest rates, I'm pretty confident, are bottoming out and starting to rise. So I'll keep that at bottoming out. That's what it looks like to me, at least. And now the yield curve, if you're a regular watcher of the show, then you know that's actually one of the charts in my list for Sector Spotlight. And we've highlighted this a few times before. This is a steepening yield curve. So this is the 10-year minus 2-year yield, generally accepted as the line for the yield curve. And you can see that we almost inverted. As a matter of fact, for a couple of hours back in November 2019, we inverted. And then we started to rise, and that rise is starting to accelerate. And if you look in the table of the sector rotation model, you can see that it's going from normal to normal steep. So that is, this period is where the yield curve is steepening. And that's what it is. It is actually steepening quite rapidly. So I'm pretty confident that based on the yield curve, we're in the early recovery phase of the economy. That means that we have the sectors which confirm that we are somewhere between full recession and early recovery. And we got at least 3 out of 4 metrics that are either already in an early recovery or moving from full recession to early recovery, like the yield curve. That's got a lot more upside to go before it is very steep. So that steepening process can actually continue for quite a while longer. So with this model in place, ticking the boxes for sectors, at least for, shall we say, 80%, 85, 90%, a nice cluster of outperforming sectors right in the middle of the curve where it is between full recession and early recovery, or a market bottoming out and moving into a bull market. And now we got 3 out of 4 macroeconomic metrics that we can quite confidently position on the early recovery or into it. And that leads to the conclusion that if that all is true, and if this makes sense, and if this all fits together, and the market is where it is, that we are actually moving into a new bull market. And that's what I was trying to say. If you look at the longer term chart, so here we have the weekly, we're actually moving higher, we're confidently moving higher, and you see that we're now about to break out in terms of relative strength. But also, if you look at the really long-term S&P chart, then we had this high here, and this was the high of February 2020, and we dropped, and we are now just above that high. We're starting to move beyond that high. So all in all, I think that the model is telling us that there is a pretty good chance that this bull market has more legs to run. Thank you very much for watching. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope you all stay safe, and if you liked the video, please give us a thumbs up. And I hope to see you again next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.